they think it's too hard. And it's too risky, too hard and too risky. I think are the two biggest hurdles, I would say, of physicians getting involved in real estate. They understand the medical game, but it's interesting. What I've found over my career is that there are a lot of the same skill sets and the knowledge base that went through to becoming a physician is actually very helpful in the investment world as well. So physicians are taught to be, very studious, learning all the technical terms, and then really being very, very diligent and methodical about their approach. We had to do that. Otherwise, you wouldn't get through, college and medical school and residency. So you've applied those same principles to real estate investing. It's a natural fit.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Some physicians wait decades to think about financial independence. Dr. Vasu Kakarlapudi didn't. An ENT surgeon, real estate investor, and founder of APTA Investment Group, he started investing just a year and a half into practice and has since built a portfolio, massive portfolio, with transactions exceeding $1 billion. Today, we're diving into his journey from surgery to syndications, how doctors can start investing early, and why real estate may just be one of the best tools for financial freedom. Here we go. Vasu, welcome to the show. Man, the time has come. I'm so excited about this conversation. So first of all, thank you for being here.
My pleasure, Brett. I'm glad to be here as well.
So I love it when, not every guest comes on is a physician. Not every guest is a real estate investor, but Vasu, you are both of those things today. So let's jump into this. Tell us a little bit about your medical journey so far.
Yeah, so I grew up in Kansas City, son of Indian immigrant parents, and I tried to, my first love was playing baseball. So I grew up in the mid-'80s with the Kansas City Royals.
Come on, George Brett, right?
Yeah, George Brett
was I was named after. Yeah, that's
Oh,
awesome.
really?
Yes. Yeah.
What a small world, Brett. So George Brett was my childhood hero. And so I wanted to play professional baseball, and so I poured my heart and soul into everything about the Kansas City Royals, and with the eventual goal of try to play for the Royals. Unfortunately, my talent didn't match my aspirations. I couldn't make up for it with hard work.
Yeah.
So when I tried out I went to a public high school, on the Kansas side in Overland Park, Kansas, and there's 500 kids at that school.
Wow.
per grade, right? So 2,000 kids in this class, in the whole school. So you had to be pretty good to even make the freshman team was even challenging. So I remember tryouts for the freshman team, and they had us sit out in center field and see how far you could throw the ball to try to catch our, assess our strength.
Yeah.
And I revved up. I'm not super tall now, but I was way smaller back then. I had a late growth spurt. So I tried to throw the ball from center field, and there were guys that were throwing the ball all the way to home plate. And I don't think my ball even got to second base. So at that point, I realized that, in order to play Major League Baseball, you had to probably at least make your high school team. And if you didn't make your high school team as a freshman, the chance of you going into playing professional baseball for a living is going to be pretty limited. So I had to give up my baseball aspirations, although I still played recreationally, and kind of focused on what I was good at. And I was fortunately pretty good in school in math and science, and I loved solving problems. And so, medicine became kind of a natural journey. So went to college and medical school in Kansas City. And then I really wanted to originally go into orthopedic surgery because I thought if I couldn't be an athlete, I could at least hang out with the athlete. Then I saw some orthopedic surgery, and I thought it was a lot of carpentry, and nothing against orthopedic surgeons. I have plenty of friends who are ortho guys, and I wanted something a little bit more delicate and meticulous. And so I really fell in love with head and neck anatomy, a lot of pinhole surgery, a lot of very precise movements that are required in surgery. So I went into ENT surgery and started practice in Metro Louisville, Kentucky, and thought I had it made until I saw a lot of the people that I looked up to, mentors in my space that were 20, 30 years older than me, that were unhappy. They seemingly had a great career and making a big impact with patients, but they got lost in the struggle of all the trials and tribulations of practicing medicine. And so I was really disheartened because I thought here I was, had this perfect career. So that's when I kind of really thought about, well, how can I do this in a way that I can have fun practicing medicine? And I saw the people that were having fun practicing medicine were the ones who didn't actually need to. They got to instead of having to. So that kind of started my real estate journey 20 plus years ago.
Yeah, the whole need versus want in that world, things change. Absolutely. And you mentioned back to the sports thing, growing up playing sports myself too, it made me think of, I think there was somebody, I think his name was something like Michael Jordan, where he had these issues early on in his career making teams and then turned out to be one of the all-time greatest, right? Yeah. The one thing I struggled with, Vasu, when I was going through, same thing, like we lived, eat, breathe, slept baseball. It was baseball, baseball, baseball. Mm-hmm. But when the field got bigger and I didn't, they increased my challenge. You talked about throwing that ball and not making it near as far as the other players. And it's like everybody went through puberty and here's little Brett and he didn't. And, so nothing could be there for an excuse for me. Ultimately, it just didn't feel like it was in the cards for me. And you as well, Vasu, and you got into ENT. And now what was that first kind of jump into real estate? Because I hear you talk about finding that separation, right? The need versus want piece, and seeing other colleagues and mentors that are not happy. And we talk about this a lot. What was that first jump for you in real estate, and how did you link that together? Say, hey, this is the path.
Yeah, I was really looking for. I wasn't falling in love with real estate. I was falling in love with the prospect of having my money work for me in a way that would allow me to practice medicine on my own terms, to the extent that I wanted to and not have to. So that began a search to kind of figure out, like, what is it that can provide a consistent return if you followed certain systems and processes. So I really relied on our surgical education. So, you learn some of the terminology and then you practice, you have mentors along the way. And you're trying to mitigate risk. So, ENT surgery in particular is you're operating in a sea of landmines. So you've got the brain on one side, you've got the eye and brain fluid and, smell centers and blood vessels and nerves and all this kind of stuff that you don't really have a whole lot of margin for error. And so the way you mitigate risk is to follow a defined path going from one landmark to another landmark. So I was like, well, how could I apply some of the stuff that I've learned and the talents and skills and the process of learning ENT surgery and transmuting that into the investment world? And so that's how I came upon real estate. So my first process there was really to try to find people. What I knew was I learned the basics by reading and podcasts weren't super prominent back then, but there was a few, and then finding mentors in the space, people who were doing this for a living, who had done this for a long time, and really spent time with them and learned how they view deals, how they do deals, and so that began a process. So to answer your question, the first deal that I did was a single family townhome, and quickly realized that midnight toilet calls and termites and tenants were a challenge. So the deal did well, but that was my initial start is in a single family home.
Very interesting. And how early in your career was it that you were able to make that connection to where, hey, I've got to do something different? Because a lot of doctors wait until it's too late when they're thinking about retirement. You have these set retirement accounts, but then there's nothing other than that. So what point in your career did that happen?
very early on, like within the first couple of years. So I started practice in 2003 and bought my first deal in the very beginning of 2005. So about a year and a half into practice is when I made that first leap, because I firmly believe that, you're not really boiling the ocean if you don't change the rules. And so I've changed the rules of trying to like say, okay, well, I want to continue to practice medicine, but I also want to establish another, path to generate income. So I wasn't solely dependent on the practice income, because, as a lot of people tell you, that diversification is the key to investing, right? That's the holy grail. And so I wanted to diversify my income stream as well, as quickly as possible.
And I'm sure you would say that that's something that you would suggest to other physicians is sooner is better than later. Is that correct?
Yeah. I mean, the best time to plant a tree was yesterday, and the second best time is today. So, it's never too late to get started. But the longer the window, the longer your runway, you can really allow the eighth wonder of the world of compound interest to work for you. So it just requires time.
Yep. What are some of the biggest misconceptions that physicians have about real estate investing?
They think it's too hard. And it's too risky. Too hard and too risky, I think, are the two biggest hurdles, I would say, of physicians getting involved in real estate. They understand the medical game, but it's interesting. What I've found over my career is that there are a lot of the same skill sets and the knowledge base that went through to becoming a physician is actually very helpful in the investment world as well. So physicians are taught to be, very studious, learning all the technical terms, and then really being very, very diligent and methodical about their approach. We had to do that. Otherwise, you wouldn't get through, college and medical school and residency. So you've applied those same principles to real estate investing. It's a natural fit.
And you've talked about your first deal being that townhouse. How do you go from townhouse to APTA? And tell us a little bit about APTA in that piece too.
Yeah, so quickly realized with a single family home that, it was very, very difficult to be able to scale that. And I wanted to focus on what I knew best, which was really finding deals and then managing the asset, doing asset management, meaning the financial analysis of the deal, but the actual property management, the day-to-day work in terms of maintenance and those kinds of things was not my area of expertise. Even to this day, I'm not an expert in that arena as well. So, in order to be able to transition and be able to afford a team that could help you handle some of those things, you had to kind of graduate to larger assets that could afford professional property management. So from that single family investment, kind of moved on to other asset classes. I really cut my teeth in trying to help other doctors and ourselves go from just being a medical practitioner to creating other businesses around practicing medicine. So, for example, surgeons, need a place to operate, right? So they need a place to see patients. They need a place to operate. So I cut my teeth in developing businesses and real estate around those businesses. So one of the biggest risks in real estate is the quality of your tenant. And so we bet on ourselves as doctors in terms of, our businesses. So why not bet on ourselves with real estate and obviate one of the biggest risks involved in real estate is the quality of the tenant. So during that process, we kind of helped a lot of our partners. We developed a bunch of medical office buildings, built a surgical hospital, and allowed doctors to have additional income streams from businesses that they directly controlled, both from the operating business entity and also from the real estate. So that opened up a lot more doors beyond medical office into multifamily and retail centers, which is kind of my primary area of focus. And so APTA, our company, was really formed after many, many trials and tribulations of working with our own money and working with friends and family. And it really grew out of a desire of our people that were around us to have access to the same kind of opportunities that ourselves and our team had developed. So
it's interesting. In the APTA investment group, what you were just speaking of there, now you've got a portfolio that's worth over $1 billion. That is incredible. Congratulations on that.
Yeah, it's total acquisitions over a period of time, and so with us and our team, and it was. Thank you, I appreciate it. It's been work in progress over 20 years, so it doesn't happen overnight.
It looks like it though, doesn't it? Like from the outside, hey,
I know
the overnight that took 30 years to do.
People only see the tip of the iceberg. They don't see how big
Yeah.
the root system is underneath there, and all the trials and tribulations that went into it.
You mentioned friends and family and affording the opportunities that you are seeing and your colleagues are seeing. And I'm just guessing that you're doing this through syndications. Can you explain on a high level what that syndication process or how that syndication process allows that opportunity for other individuals to reap the benefit of what you got going on?
Yeah, I think to take a step back, I think there's two real ways that people can get involved in real estate. So one is an active participation. So active deals that you go out and find, take care of all of the acquisitions, the finance, the debt, the property management, et cetera, et cetera. But there's economies of scale when people can pool their capital together and go and buy larger assets. And when you buy those larger assets, you need somebody to be able to you can't have too many chefs in that kitchen. You need somebody to be kind of the chef and be a good steward of everyone else's money. And that's really where syndications kind of come in. It's a way for a lot of investors to pool their money together and all be fractional owners in the asset itself, but choose a team that is in charge of finding the deals, putting the deals together, taking care of the financing, managing the asset, and ultimately disposing of the asset. So that's in broad terms how a syndication works. There's a ton of more nuances into it, but think of active as you're doing everything yourself, and passive syndications as a way for you to pool your money with other folks so that you can take advantage of the economies of scale and the expertise of the team to buy larger assets that, ironically, are actually less risky. So larger assets in real estate tend to be, not always, but tend to be less risk than the smaller assets.
Yeah. Interesting. When you say dispose of an asset, it almost sounds like you're throwing it away, but it's more along the lines of disposition. You're moving it. Yeah, you're moving it to another platform, basically selling it, right?
Yeah. Thank you for clarifying that.
Yeah, I don't know if that's the right use of the word or not. I just wow, I just really we're just going to throw it away. No, we're going to capture the equity.
Didn't match up. The connotation didn't match up.
Yeah, we're going to capture the equity. But speaking of equity capture, we're talking about equity multiple, and there are some things when we're looking at syndications, these returns that we're looking at, and I think the three big ones would be cash on cash return, the IRR, and the equity multiple. When those three high level return targets, what are you looking at when you look at a multifamily deal? Is there a way you can generalize that for us?
Yeah, I think it really depends upon each individual investor's needs. So some investors are looking for cash flow, right? And so you're going to want to probably focus more on the cash on cash returns. And so that's typically going to be, maybe in the multifamily world, maybe in broad terms, apartments are graded A, B, and C. So think of A grade as the, $2,000 plus per month rents, and maybe the B grade $1,000 to $2,000, and maybe the C grade older apartments that are, $500 to $1,000 range. So in general, the cash flow tends to be stronger with the lower grade assets. So if you're really looking for cash flow, you might want to consider some of the C grade apartments. So that's one approach. the multifamily world has been, as your listeners know, it's been a very turbulent market over the last few years with this rapid rise in interest rates. And so the cash flow on a lot of multifamily deals right now is pretty skinny. It used to be, you could get 5 to 10% cash on cash returns on a lot of multifamily deals, and now it's lower than that. So that's one aspect of returns. You mentioned the equity multiple, so that's kind of realized after a transaction occurs. And most investors, want to at least double their money over the course of 5 to 7 years or so. So, and then internal rate of return, as you mentioned, is another metric that's used, and that's time sensitive. So, in general, the sooner you get money back, the larger your internal rate of return is. So, I've seen deals that have had, for example, have a equity multiple that maybe only 1.2 or 1.3, but because they're getting the cash back really quickly, their IRRs are really, really high. So we don't need to get too far into the weeds, but just sometimes you have to figure out what you're optimizing for. So if you want cash flow, you're looking for that. If you're looking for long-term growth that you can just park money and double your money, then you're looking at equity multiple. If you're looking for a quick turnaround of your money and you just want to renovate an apartment real quick and capture higher rents and then sell, you're going to want to focus on IRR because you're getting your money back faster, even though it may only be 1.2 or 1.3 as opposed to doubling.
Yeah, and this current challenge when it's looking at cost of money in the multifamily space. Tell me a little bit how you see this. How does the interest rate on a cost of money on a loan? So say that the cost of money is say 7%, but we're investing in a market where the cap rate is 5%. How do those two numbers correlate together?
That's a tough situation. That what you're describing there is a situation that's called negative leverage, right? So you don't have your cost of capital is higher than your cap rate. It's really hard to get any cash on cash on that. So you've got to be banking on, if you're doing that in your example of borrowing money at 7% and buying an asset at a 5 cap, you essentially are banking on growth of that market. And you've got to be relying on long-term growth at the expense of current cash flow. You have to. It would be very, very challenging to expect any cash flow in that situation.
Yeah, and it's hard. And when I'm looking at deals too, it's like and right now you're probably seeing this too. Offers that we're writing are so low because it's like I have to have deals that cash flow. There's no doubt about it. I'm not going to buy something that's not going to cash flow. So we get more no's right now. Are you feeling that too?
Yeah, absolutely. To give you an example, last year in 24, we only closed on one deal, and our motto has never been to adjust our filter to make a transaction occur. That's where patience is super, super essential. You just have to sit tight. And in 2022, we did like 6 deals. So it's just a matter of waiting for that timing when the fundamentals, you can't sacrifice on the fundamentals. The more you adjust your filter, the more risk you're introducing into a deal.
Yeah. It's very interesting. And not only do you get not only do we get no's, Vasu, it's you're crazy. You don't know what you're doing. And then we've been lectured by so many agents and, different scenarios where you've got to look at this and this is pro forma and this. And it's like, no, no. This is the way it works in our system. That's the way that we have to go. And the patience is challenging. You're not trying to make a deal. Yes, we can be creative in certain scenarios, but we're not trying to make a deal. We're trying to find a deal. And you've got to you got to trust the process. You have to have faith and trust the process 100%, which, hey, this is a whole nother thing. How do I trust the process when I'm new at this? When I feel like, I've got the kind of personality where I continue to learn. I never want to stop learning. And maybe I'm not learning something right. Maybe I've got something wrong because my offers are coming in half of what somebody's asking, Yeah.
I think the key thing is to work with somebody who has done this before And just here's what I did. I'll share with the listeners. I found a patient of mine who I'd taken care of as was real significant, had significant experience and been doing this for 20 plus years, and been very, very successful. So I would read and, like you said, learn all the basic terminology, and then on my own time, and I just asked if I could come in and just see how you evaluate deals. And that's what I used to do after office hours and surgery, visit with my buddy. And over a period of years, I gained enough confidence after, practicing essentially, with learning the way that he did things and looking at deals that way. It gave me the confidence to be able to finally execute, because I was a firm believer that, knowledge without execution is just entertainment, right? It's just a way for you to entertain yourself. And we're not in this business to necessarily just entertain. We want to actually execute. So you have to be able to execute, but at the same time, you don't want to be premature in that. So I would suggest you latch on to somebody who's done this before. This is what we did in residency. Like, I didn't take out my first tonsils the first time I saw it. I read about it. And then I had somebody, I watched a bunch of people, and then I had another person attending, watch over me before I was independent. So you follow the exact same process.
Yeah, very interesting. And sharing that knowledge is huge. Executing, taking action, and you've done both of these things. We talked a little bit about this before we went on air here today, Vasu. You've written a book. Tell us a little bit about that.
Yeah. So, you get to a certain point in your life where you're like, life has to be about more than just about you, right? Once you've achieved a certain, modicum of success, it really becomes like, how can you give back and leave this world better off than where you came in? And so, so this book has been a labor of love. It's called The Surgical Investor, and it really outlines kind of the trials and tribulations that along my journey. And the goal of that is to really help inspire other physicians and surgeons to find their own journey. It's not going to be the same journey, but it's really about studying success patterns of other people who've done what you want to do. This is exactly what I did, and trying to implement, different areas, different stories, and different skill sets and mindset, and how you could apply that to your own life. And so, my way of kind of giving back to our community and is to hopefully inspire at least 1,000 surgeons to get to a point where they're not solely relying on their surgical income to feed their families and fund their lifestyle, but instead have other sources of income so that they get to, instead of having to, practice medicine. And the downstream effects of that to society is tremendous, because I noticed this with other investors that we've had, is that when you get to a point where you are getting to practice medicine instead of having to, you become much more of an empathetic, compassionate physician. And patients sense it. You don't have to play the game, as working with a bunch of doctors, that we're reimbursed based upon volume, but we're wired to provide quality. But the financial incentives don't reward you for the quality, they reward you for the volume. But when you have other sources of income, you're not so much dependent on that financial reward of practicing medicine. And as a result, your whole life changes, Brett. I mean, you get to a point where I've seen investors, change the way that they approach patients. They've got a spring in their step. They've got more time to take care of their health. Their mindset is better. They've got better relationships. They're really enjoying the connections that we make, where it's a real gift to be a doctor. And we want to try to give that gift and enjoy the gift so that we can connect better with our patients.
Yeah, that's amazing. And just coming back to that thing, and you and I, we say it just a little bit different, but the need versus want, for me, that's something I've as a contractor or building a company, like whatever, when I'm in a situation where I need something versus when I'm in a situation where I want something, it's completely different. And get to versus have to. I love it. I love it. And I can feel like a glow happening inside of me when you explain that. So I know that I experienced that same thing, and sometimes my perspective may shift off of that. So I love that that's in here in this book, and there's so many more things. I mean, we could probably do a whole nother conversation just on the book, but we are pre-production, pre-release on this book right now. How can the listeners find this and learn more about the surgical investor? Love that name, by the way.
Yeah, thank you. A lot of that information, we have a ton of educational resources, and including access to the book through aptainvest.com /learn. And it kind of shares some of the trials and tribulations that I've gone through to hopefully help shorten that learning curve for others, so that, they always say, a dumb man doesn't learn from his mistakes. A smart man learns from his mistakes, and a wise man learns from the mistakes of others. Yeah. And so our goal is to really help as many surgeons as we can, at least 1,000 surgeons. That's kind of my BHAG, so to speak.
Yeah.
Big, hairy, audacious goal from the Jim Collins world of lifting at least 1,000 surgeons over the next couple of years to be financially free and really bring back the enjoyment in the practice of medicine.
Jim Collins, that was a book built to sell. Is that right?
Good to Great. Good to
Great. That's it. Yeah.
Good to Great is the one that I was referencing here. So.
Yeah. Good to Great. Absolutely. Love that book. The old BHAG. So that's your personal BHAG. It sounds like. Tell me a little bit about what's next for Alpha Investment Group, and maybe the next 5 or 10 years. What are you seeing as far as real estate opportunities that you'll be offering the group?
Yeah, so APTA is really a Sanskrit word for trust. And so part of our mission is to build more and more trust. We've got that trust bridge with people who've known us for a long time. And our next evolution is to provide those same opportunities that we invest in ourselves. So me personally, I'm usually the largest investor in every deal that we do. If it's not good enough for us, we would never bring it to our investor base. And we're focused on kind of 3 specific asset classes: multifamily, medical office buildings, and retail centers. So think of like not the big box retailers, but like the small e-commerce resistant tenants at in high traffic areas in growth markets. So think of like your dentist, the chiropractor, the nail salon, haircut place, the local restaurant that everybody loves to go to in the neighborhood. So those are the 3 main asset classes that we're looking at. And to be honest with you, right now we're spreading our top of the funnel, essentially trying to look for more and more deals, but we're not adjusting our filter. So we're very, very stringent on the requirements. And so it's just requiring us to be more creative about how we find these deals by expanding our outreach.
Mm-hmm. Very cool. And what markets is that, Vasu?
So the medical office and retail stuff, we're looking primarily. We live in Louisville, Kentucky, so we know this market really well. So we've got a lot of assets in this area. We're also expanding to other Midwestern markets, namely like Indianapolis, Indiana, and Columbus, Ohio, and surrounding areas. The multifamily world, we focus on even higher growth markets where there's even more positive population movement. So think of Texas, the big markets in Texas: Dallas, Houston, Austin, San Antonio, Atlanta, Georgia, the Carolinas. So we've got an asset in close to your neck of the woods, in the Charlotte area as well. So
very cool. Very cool. Absolutely. And the last little piece here, for physicians who are just starting their financial independence journey, what's the one thing? You ever read that book yet?
Yes, by Gary Keller. Yeah.
Sorry about that. I was going to clear the one thing. But what's the one thing that someone who's just getting started to build passive income should do today?
Take action. I've seen too many doctors. Doctors are great students. I have to consciously, whenever I read something or learn something, I immediately take notes on how I can apply that knowledge to whatever I'm doing. So I would say the number one thing is learn as much as you can, but take some action. It may be as simple as going to a course or networking with some other real estate folks, and just learn the lingo. And it doesn't mean go buy a deal the first time you read a real estate book. It means, take some action. What is the next one thing that can make everything else easier or obsolete, is I think how Gary talks about that. So, you just have to make sure that you're making forward progress. That creates momentum. So now, we mentioned it earlier, right? So knowledge without execution is entertainment. So don't look at this as entertainment. You make sure that you're taking some action.
That's awesome. And taking action by, first of all, listening to the Real Estate Mogul MD or being a guest on the Real Estate Mogul MD. I really appreciate that, Vasu. And for the listeners, the action piece can be going to aptainvest.com. The URL's in the description here. But check out what you've got going on, the resources you've got there. Check out the book as well, too. So best wishes on your journey, Vasu. Thank you for your time today.
Yeah, enjoyed being here, Brett.
Awesome. Thank you so much. Physicians don't have to wait to start building wealth. You just have to start now. You just have to start. Just take action. Here are some key takeaways, some notes I threw in the bucket today from my conversation with Dr. Kakarlapudi. The best time to start investing was yesterday, but the second best time is today. Real estate isn't as risky as doctors think. If you follow proven systems, you can reduce risk and scale faster. And finally, financial independence lets you practice medicine because you want to, not because you have to. Want to learn more? Visit aptainvest.com, APTA invest.com, and grab a copy of the brand new book, The Surgical Investor. Thank you again for your time today. And as always, thank you for your attention. This is the Real Estate Mogul MD.